Why do we look at performance? Because the income statement, which measures yearly performance, eventually determines how rich we are. If every year we are making tens of millions, we are obviously billionaires by the time we retire, which of course is the minimum that we want. The better the performance, the richer we are. So the income statement flows into the balance sheet, and the balance sheet is a large indication of the wealth of the company. So the better the firm performance, the more the company's wealth. The equity will be more. What is shareholders' equity? The cash we invested at the inception stage, plus the value added we make every single year. From that perspective, the wealth of the company is what we initially contributed, plus the earnings we have during the year. If earnings are positive, which we hope they always are, then the company is richer. Remember, if earnings are positive, then you are having an increase in assets. Hence, the equation that you are seeing in front of you, the right side will increase because you have more earnings. And the left side will increase also because the positive performance gave us more assets. Think of it this way. If our initially shareholders' equity was 500, and if we have a further earnings of 100 this year, then our final shareholders' equity increased by 100. And assets increased by 100 also. Now, if you want to break this down further, if a company pays dividends, then the assets, cash in this case, flows out of the company. As such, the company will be proportionately poorer, and the assets will be lower. Take, for example, earnings are 100 and you pay 25 of dividends. In this case, assets will increase by only 75, and equity will increase by 100 because of earnings, minus a 25 reduction because of the payout of dividends. So now, if our initial equity was 500, and the final equity will only be 575, and not 600, because we paid out 25 of dividends. So let me now throw out a definition for all of you. Retained earnings are the cumulative net earnings or profits of a company after accounting for dividend payments. As an important concept in accounting, the word retained captured the fact that because these earnings were not paid out to shareholders as dividends, they were instead retained by the company. Although theory is nice, hope you got a nice introduction. Of course, we need some examples. Let us try out a few with a manufacturing company like Apple. The first step is to start the company. And let us imagine that we do so with $100 of our own investment. Both cash and common stock will go up. One under assets and the other under equity. The equation always, of course, balances. Given that we are a manufacturer, we need to purchase raw materials so that we can start our production. We purchase raw materials that would be plus 60 on the asset side. We have purchased the raw materials on account payable within 30 days, so we register an accounts payable, which is cash owed to a supplier of another plus 60. Next, we pay our suppliers. We are nice and we pay them on time, especially that we would like to maintain good relations with our suppliers. Now we start the production process. We get some employees, pay them wages of $15, and ask them to produce our inventory. Assume we are producing something fancy, not a silly widget. Let us say we are super ESG carbon capture improving the world microchips that can be inserted into plastics. Now we see that when we conduct our manufacturing process, we convert our raw materials into inventory. Given that we spent $15 of labor to convert $60 of raw material, then the value of our inventory is now $75. Please notice that we do not have any expense on the income statement. Simply, the cash paid to employees becomes part of the inventory. Here comes the nice part. Here we are selling our super ESG carbon capture microchips. Assume you are selling it for 90. We put revenues of 90 on the income statement, and the cost of these ESG microchips is 75. So we make a cool profit of 15. We are richer, of course, so equity is more by 15. The account that we increase is retained earnings. Remember, good performance means more equity, and income always flows into equity. Under the asset side, the inventory is gone, and instead we have a receivable. The customer has promised to pay us within 60 days, so we record a receivable. "60 days have passed, and the customer paid us. We have more cash, and we cancel the accounts receivable on the balance sheet. They do not owe us anymore, so it should no longer be there." We are happy with our performance of 15. Remember, net income was 15. We decide to pay 10 of dividends. Cash goes down, and we have less equity under the item retained earnings. The company now is poorer as there is less equity, but shareholders are happy because the cash is in their pockets. The decision to pay dividends means that the company does not want to reinvest its earnings to grow and expand. Rather, they prefer to return money back to the shareholders.